Welcome to another deep dive, and today we're going well, I guess where a lot of people don't want to go. Right into fear and greed. We're diving into Buy the Fear, Sell the Greed. 7 Behavioral Quant Strategies for Traders by Lawrence A. Connors.
Yeah, Connors. So he's got decades of experience, right? Started as a floor trader and then, went on to found Connors Research, which is all about developing quantitative trading strategies.
So he's been in the trenches, not just theorizing, which I like. And this book, well, it's packed with strategies he claims have been tested and, get this, actually work.
And a lot of them, based on this idea that markets aren't always perfectly efficient, right? That human behavior can create these predictable, exploitable patterns.
Yeah, he kind of takes this efficient market hypothesis and turns it on its head, right? Like, because humans are involved and we're emotional creatures, there are going to be these moments of irrationality that can actually be predicted.
Exactly. And he really focuses in on fear and greed, how those emotions can drive prices away from their true value. One of the most compelling examples is his RSI power zone strategy, particularly for the SPY, the S&P 500 ETF.
Yeah, this one was a real eye-opener. He claims a 91% win rate since 1993, and all by just buying when the 4-period RSI dips below 30, as long as SPY is above its 200-day moving average.
91%, that's incredible. He attributes it to fear, basically creating a liquidity vacuum. Prices get pushed way down, way below what they should be, and that's when you pounce.
But 9 out of 10 times. Is it really all just fear, or is there something else at play? Like, are algorithms picking up on these same signals and amplifying the effect?
That's a great question. It could be a self-fulfilling prophecy, right? The algorithms see everyone else panicking, so they panic too, which drives the price down even further.
And he gives some pretty vivid examples of this, like during the Brexit vote or when everyone was worried about interest rates back in 2018. Those were definitely times when fear was, pretty palpable.
Oh yeah, fear was definitely in the air. And he highlights how the media plays a role too. They often amplify the fear, right? Push that RSI down even further, creating these ideal entry points. It's like they're doing half the work for you.
Okay, but buying when everyone else is freaking out?
Yeah.
That just feels so counterintuitive. Isn't there a huge risk that the market's right to be panicking, that the fear is actually justified?
There's always risk, of course, but you got to manage it, right? Connors is very clear about that. He talks about position sizing, stop loss orders, all those tools that help you limit your downside.
So it's not just blindly jumping in. There's a method to the madness. But I have to say, I'm much more comfortable with this idea of, well, selling into greed. So let's talk about this carry H strategy, which targets those stocks caught in these insane hype-driven rallies.
Yeah, the ones that just seem to defy gravity. Connors looks for stocks with 3 consecutive days of 5% gains, high volume, and a Connors RSI above 90. Basically, when you see that combo, he's saying greed has taken over.
I can only imagine the feeling of shorting a stock that everyone else seems to be piling into. Talk about contrarian, but I guess what goes up must come down, especially when it's fueled by, well, pure speculation.
Right. And based on his research, the CRH strategy boasts a win rate of over 70%. But it takes guts, right? You got to be disciplined to stick to the rules, even when it feels like that stock might never stop climbing.
And he gives some wild examples too, like overstock during the whole crypto craze and HTG molecular diagnostics when those buyout rumors were swirling. Those were some crazy times.
Classic cases of hype and speculation driving prices, way beyond anything reasonable. And while the rewards can be huge, the risks are real too. Connors really emphasizes using options, specifically put options, to limit your potential losses when shorting. It's all about protecting yourself.
Makes sense. So we've covered buying fear, selling greed, but what about just profiting from volatility itself? I mean, isn't that what the VXX is all about?
Yes, the VXX. This change traded note designed to, well, profit from rising market volatility. But here's the kicker. It's almost like it's designed to fail.
Wait, what? Designed to fail? How is that even possible?
It comes down to the VXX's structure. It holds these near-dated VIX futures contracts, which it constantly has to roll over. And the problem is those futures are usually priced higher for later dates, a situation known as, well, contango.
Contango. I'm not sure I followed.
Okay, imagine, like, concert tickets, right? As the concert gets closer, prices go up because, demand is high and supply is limited. It's kind of the same with futures contracts. Closer you get to the expiration date, higher the price. So every time the VXX rolls over its contracts to later dates, it's essentially buying high and selling low, taking a small loss.
Ouch. So even if volatility spikes, the VXX can still lose money because of this contango thing.
Yep, and it gets worse. VIX futures, which are kind of like insurance against market drops, they tend to be overpriced anyway. Investors are basically paying a premium for fear, like buying an umbrella on a sunny day at twice the price, just in case it might rain.
So why do people even buy the VXX then? It sounds like a recipe for disaster.
Well, fear plays a role, right? In times of uncertainty, people flock to it as a perceived safe haven, often without fully understanding how it works.
Ah, so it's kind of like a trap for the unsuspecting investor.
You could say that. But Connors, he sees this as an opportunity. He's got two specific strategies designed to profit from the VXX's decline.
And that's what I'm talking about.
And we'll get into those right after this. So those strategies for profiting from the VXX, you ready to dive in?
Oh, yeah, absolutely. I'm all ears.
Yeah.
Especially after you called it a trap.
All right, so the first one is called vol panics. It's a short-term play, really, that capitalizes on those sudden jumps in volatility, often driven by, well, panic.
Shorting the VXX when everyone else is running for cover. That sounds a bit like playing with fire.
It can be, yeah, but Connors has a very specific setup.
Yeah.
You short when the VXX is above its 5-period moving average and its 4-period RSI is above 70.
Yeah.
Basically, you're looking for signs that fear has driven the VXX up way too far, way too fast.
So you're betting that the panic will subside, that the VXX will, come back down to earth. But what if the fear is, well, justified? What if the market keeps dropping?
Well, that's the risk, right? But Connors' data shows that this vol panic strategy has actually been, right, get this, 74% of the time since 2009.
74%. So more often than not, those panic-driven spikes are just overreactions.
It seems so, yeah. And for the really aggressive traders out there, Connors even suggests scaling into the position. So as the VXX climbs higher, you just keep adding to your short position.
Okay, that's definitely not for the faint of heart. I can see how it would, magnify the gains, but it also magnifies the risk, right?
For sure. Higher reward, higher risk, always. That's why Connors is a big advocate for options, especially put options. They can really help you limit your potential losses when you're shorting. It's like having insurance on your insurance.
I like that. Insurance on your insurance. So that's the short-term panic play.
Yeah.
What about this longer-term strategy you mentioned?
Right. That's the VXX trend strategy. And it's all about riding the long-term downward trend of the VXX. You're not trying to time those short-term spikes. You're betting on the fact that the VXX is designed to lose value over time.
Sounds almost too simple. Just bet on the inevitable decline. How effective can that really be?
You'd be surprised. Even this basic trend-following approach, when applied to the VXX, has a win rate of over 50%, with an average holding period of almost 3 months.
So you're not just, scalping a few bucks here and there. You're potentially capturing a decent chunk of that long-term decline.
Yeah.
But I guess that also means your capital is tied up for longer, right? You could miss out on other opportunities.
Yeah, that's the trade-off. And of course, you're exposed to the risk of the VXX suddenly spiking, going against that long-term trend. That's why those deep in the money put options can be so valuable. They can really help you manage that downside risk.
Okay, starting to see how options can be a real game changer, especially when you're dealing with volatility.
Yeah.
Now, you also mentioned the strategy for trading new 52-week highs, which just seems, well, counterintuitive. Isn't the whole point to buy low and sell high?
Right. That's the classic advice. But Connors argues that stocks near their 52-week highs actually tend to outperform, and he's got, academic research to back it up. He thinks that 52-week high acts as a kind of a psychological anchor, drawing attention and creating this short-term overreaction.
So investors get excited about those new highs, and they push the price up even further.
Exactly. But he's not saying to buy at the peak, right? He waits for a pullback, a sign that the initial euphoria has worn off.
Okay, so it's all about timing. How do you pinpoint those pullback opportunities?
He looks for 4 specific criteria. High volume, at least 1 million shares traded daily, got to have liquidity. Second, a recent 52-week high within the past 20 trading days. Third, the ConnorsRSI needs to be below 15, indicating that the stock is getting oversold.
There's that fear indicator again.
Yeah.
So we're looking for signs that the excitement is fading and the fear is starting to creep in. What's the 4th criteria?
A pullback of at least 7%, ideally 10%, from that recent high. That confirms that the momentum is shifting.
So you're buying the dip, hoping to catch the stock before it rebounds. When do you know it's time to sell?
Simple. When the ConnorsRSI closes above 70, that signals that the fear is gone and the upward momentum is back.
So it's not just chasing highs blindly. It's about recognizing those patterns and exploiting the pullback. Sounds pretty clever. How well does it actually work?
Well, from 2001 to 2017, this strategy yielded a win rate of over 75%. 3 out of 4 trades ended in profit.
That's pretty impressive. Any real-world examples of this in action?
Oh, yeah, he gives a couple. One is Calithera Biosciences, a biotech company that soared to new highs back in 2017 on some positive drug news. Stock pulled back, triggering a buy signal, and then boom, a week later, it was up over 14%. Another example is Viva Systems, same story, rallied to new highs, pulled back sharply, and the trading new 52-week highs strategy would have caught a nice gain there too.
Okay, so it's not just theory, it's actually been proven to work. But as with any strategy, got to manage that risk, right?
Always. Not all pullbacks are created equal. Some might be, a sign of a bigger reversal. Using stop losses, that's crucial.
All right, so we've got buying fear, selling greed, profiting from the VXX's, inevitable decline, even buying new highs. Is there like a unifying theme to all of this?
Definitely. All these strategies are based on the idea that markets, well, they're not perfectly efficient, right? Human emotions create these predictable patterns, and those patterns, well, they can be exploited.
And that's what Connors is so good at, finding those patterns and turning them into actual trading strategies.
Exactly. Now, there's another one I think you'll find interesting. TPS stands for time, price, and scale in. It's all about systematically buying into fear and selling into greed.
Buying fear and selling greed. Okay, you've got my attention. How does this TPS thing actually work?
So let's start with the long side. You're looking for ETFs, ideally in a longer-term uptrend that experience a sharp pullback.
So you're waiting for everyone else to start selling. Sounds familiar.
It is, yeah. But instead of, jumping in all at once, you buy in stages as the ETF continues to decline. This helps you average your entry price and potentially capture a bigger move to the upside.
So if it keeps dropping, you just keep buying. Isn't that a bit like, trying to catch a falling knife?
It can feel that way, but that's where the time and price components come in. You're only adding to your position if the ETF closes lower for 2 consecutive days and its 2-period RSI drops below, say, 25.
So you're not just buying any dip. You're looking for specific signals that suggest the selling is, driven by fear, not some fundamental shift.
Exactly. And you're not buying equal amounts either. Connors likes to scale, and you might buy 10% of your intended position on the first signal, then 20% more if it closes lower the next day, then 30%, and finally the remaining 40%.
So you're gradually increasing your position as the fear intensifies. But what if it starts to recover? Do you still buy more?
Nope. You only buy more if the fear continues to drive the price down. The exit signal is pretty straightforward. You sell your entire position when the 2-period RSI closes above, say, 70. That means the fear is fading and buyers are coming back in.
Okay, so that's buying into fear. What about the short side? How do you sell into greed?
It's the mirror image. Instead of buying dips, you're shorting rallies. You look for ETFs, ideally in downtrends or below their 200-day moving average that are experiencing a short-term surge.
So those stocks that everyone else is piling into, the ones that seem to be defying gravity, those are the ones you're targeting.
Exactly. And just like on the long side, you scale into your position as the ETF continues to rally and its 2-period RSI climbs above a certain threshold.
Okay, so you're fading those greed-fueled rallies.
Yeah.
And I'm guessing the exit is when the RSI falls back below a certain level, right? Signaling that the greed is fading.
Yep, you got it. Usually you'd cover your short position when the 2-period RSI closes below 30. That usually means the rally is losing steam.
So TPS is this versatile tool that can be applied to both long and short trades, always looking for those opportunities created by emotional extremes. I like it.
That's what makes it so powerful. And the test results are pretty compelling, too. Win rates ranging from 77% to 94%, depending on the specific ETF and the scaling in approach.
Those are some serious numbers. Any real-world examples of TPS in action?
Of course. He shows TPS working across a range of ETFs, including those tracking, markets outside the U.S. One example is the iShares China Large Cap ETF, FXI, which had a pretty sharp pullback back in August 2015, when global markets were in turmoil. TPS would have signaled a buy, and within a week, the ETF had rebounded significantly.
So even in those volatile emerging markets, TPS can potentially spot those fear-driven dips. That's pretty cool.
Yep. And for a short side example, Connors highlights the iShares MSCI Brazil Capped ETF, EWZ, which rallied pretty hard in late 2016, even with all the political turmoil going on. TPS would signal to short, and sure enough, the rally fizzled out pretty quickly.
Okay, so TPS, you can use it to exploit both fear and greed across different markets, different asset classes. Very cool. But as always, got to ask about risk management. Scaling into a position, especially on the short side, that just seems inherently risky.
You're right. Risk management is absolutely crucial with TPS. Connors really stresses stop losses. Gotta have them to protect yourself if the trade goes against you. And options, as we've talked about, those can provide a nice safety net, especially on the short side.
All right, so we've covered RSI power zones, CRAH, the VXX strategies, trading new 52-week highs, and now TPS. Definitely seeing a recurring theme here. Fear and greed, they're powerful forces that can create some pretty predictable opportunities.
Exactly. That's the core message of Connor's book, right? He's not claiming to have some magic formula to beat the market, but he's giving us a framework for understanding market psychology. He's showing us that fear and greed, while often seen as, negative, can actually be powerful tools for those who know how to use them.
It's like instead of being afraid of those emotions, you embrace them, you see them as opportunities.
Right on. And while he provides a framework, specific strategies, he also emphasizes adapting and evolving. He wants readers to test his ideas, refine them, develop their own unique approach.
So it's not a one-size-fits-all thing. It's about finding what works for you, for your risk tolerance, your trading style.
Absolutely. And that's what's so great about this book. It's not just, a set of rules. It's a launching pad for exploration and self-discovery in the world of trading.
Well said. So we covered a lot of ground today: RSI buy-war zones, CRHH, the VXX strategies, trading new 52-week highs, TPS. It's been quite a journey into the world of behavioral quantitative trading.
It has been, yeah.
And to our listener, what are your thoughts? Which strategy resonates with you the most? Remember, this is just the tip of the iceberg. Keep exploring, keep learning, and keep diving deep.
All right, so we're ready to tackle those terror gaps, right?
Yeah, they sound kind of scary, but also, I don't know, exciting in a way.
Yeah.
Like, is this where the real money's made?
Well, they can definitely be profitable, especially if you have the stomach for it. You're essentially profiting from pure panic, from those moments when fear completely takes over the market.
So walk me through, what exactly makes a terror gap a terror gap?
Okay, imagine a stock or ETF. It's been showing some weakness, maybe a couple of down days, and then bam, it gaps down significantly at the open, usually on the back of some, bad news or a broader market sell-off.
So it's not just a normal dip, it's a sudden drop, a real visual gap on the chart.
Exactly. But it doesn't stop there. That's the thing. The selling continues. The stock keeps plunging throughout the day, and panic just sets in. People are just desperate to get out.
Yeah, I can see why they're called terror gaps.
Sure.
But you're saying Connors sees this as a buying opportunity. You're buying when a stock is plummeting like that.
That's right. It's not about shorting. It's about buying from the panicked sellers, the ones who are willing to sell at any price just to get out.
That goes against everything I've ever learned about trading. Buy low, sell high, right?
Yeah.
Not buy when a stock is in free fall.
I know, it's counterintuitive, but think about it. When everyone is selling, that's when prices can get really disconnected from reality. It's like a fire sale where you can pick up some incredible bargains.
So I see your point. But how do you know when to actually buy? How do you identify a real terror gap?
Connors has a pretty clear set of rules. First, got to have some recent market weakness, maybe a few down days leading up to the gap. That kind of sets the stage for the panic.
So the market's already on edge. Got it.
What else? Then you need a significant gap down at the open, like at least 2% or more. That confirms that the fear is real, it's taking hold.
Okay, so we've got the initial shock. What happens next?
This is where it gets really interesting. You want to see the stock or ETF keep selling off, dropping at least another 3% from that opening price.
Wow, so a gap down followed by another leg down, that's when you know it's a real terror gap.
Exactly. And that's when you pounce. Connors recommends placing a limit order to buy it. You're buying from those panicked sellers who are just running for the exits.
Okay, I'm starting to see the logic, but man, it takes some serious guts to buy into a downward spiral like that. When do you know when to sell? When is it safe to get out?
Connors uses the Connors RSI here too. He says to exit the trade when the Connors RSI closes above 70, that usually indicates that the fear has subsided and the stock is starting to recover.
So you're riding the wave of that relief rally. Makes sense. But this all sounds pretty risky. How well does this actually work in the real world?
Well, it's definitely risky, no doubt about it, but the potential rewards are huge. From 2006 to 2017, buying into terror gaps across a basket of liquid ETFs, it yielded win rates ranging from 70% to over 80%, depending on the severity of that intraday drop.
Wow, those are some pretty impressive numbers. Any real world examples of this tear gap strategy in action?
Oh, yeah. One that stands out is the Direction Daily Semiconductor Bull 3X Shares ETF, ticker SOXL. Back in September 2016, after the Fed, hinted at raising rates, the ETF experienced a classic terror gap, plunged over 10% on the day, triggered a buy signal, and then within minutes reversed course and closed almost 9.5% higher.
Talk about a wild ride. Buy the fear. Get rewarded handsomely. I like it.
It just shows you how quickly sentiment can shift in those panic situations. And for those who had the courage to buy into that fear, well, they were definitely rewarded.
It's amazing. But this definitely isn't for everyone, right? Any advice for those who might be a little hesitant to jump into these terror gaps?
As with any trading strategy, gotta manage the risk. Connors always emphasizes using stop losses to protect yourself if the trade, doesn't work out, and options, as we've discussed, those can be a great tool to limit those potential losses.
All right, so we've covered a lot of ground in this deep dive. RSI power zones, CAC-H, VXX strategies, trading new 52-week highs, TPS, and now terror gaps. It's been fascinating to see how Connors, takes these basic human emotions, fear and greed, and turns them into actionable trading strategies.
He really does, yeah. He's not just giving you a set of rules. He's teaching you a whole new way of thinking about the market, how to read the emotional landscape and use it to your advantage.
It's turning conventional wisdom on its head. It's really quite brilliant. Well, a huge thank you to our expert for guiding us through this deep dive into buy the fear, sell the greed. It's been a real eye-opener, and I'm sure our listeners have learned a ton.
My pleasure.
And to our listeners, what are your thoughts on all of this? What resonated with you? What scared you? We want to hear from you. Remember, this is just the beginning. Keep exploring, keep learning, and keep diving deep.